On today's episode of the AI Investor Podcast from 24/7 Wall Street, we're going to tell you exactly what happens next with tariffs. Just kidding. We are going to dive into the earnings from some of the most popular AI companies. All of that is next. Welcome back to the show. I am David Hanson, joined by Eric Bleeker. Eric, we're a little bit behind schedule. We apologize to the listeners. We're a few days late. So just wanted to get that out of the way, but we are here now.
Yeah, David, it's good to be back. As you know, we've had some things happening in the background. If anyone here is a member of the Motley Fool, they probably know some emails coming from me. So I have my whole businesses, and in addition to that, I am working with the Motley Fool. That doesn't mean that we will see an end to the podcast. We plan to continue filming the podcast, but it does present some legal complications in other areas. So working through that, so that just means we're going to talk about AI. We're going to talk about developments today, but I have to be a little bit more cautious about how we discuss things like buying stock. So we won't have any buys that we're going to discuss today. I will work through how we do that in the future. But I did want to mention that because I have gotten a few emails from people saying, "Hey, I saw some emails from you in the Motley Fool. Is the podcast ending?" No, nothing will change on that front. We plan to continue breaking down all the most important news in the AI space.
Perfect. Well, as long-term listeners might know, you obviously spent 15 years at the Motley Fool, a lot of experience there. So, there's discussions on you coming back, helping them out with some of their research. So that's kind of the nature of the relationship. It's not a brand new company to you stepping back in and helping them with some of the research. But again, yeah, like you noted, the Motley Fool has certain disclosure policies that prevent you from talking about certain things in a certain window. So trying to adhere to their standards as well and be a good partner. But as you said, we're going to continue to try to deliver the most value here. And if you're a member of the Motley Fool, great, because you're going to get a double dose of Eric and his insights. So hopefully it's not too much Eric, but I don't think that's possible. So like I said, it's been 2 weeks. As always, market's been very up and down. We've had a bit of a rally. I think the other day we almost kind of made it back to that post-Liberation Day rally after we've given some of it back. So let's just kind of do a quick catch up on where we stand with some of the events going on in the market and where we are kind of from a market level standpoint.
Yeah, David, you've done a job kind of discussing today and how that relates to COVID, in the sense that COVID, the market was able to see through a lot of the worst elements and headlines. That we actually saw a rebound at a time when COVID looked like it was, raging at its highest levels. And if you look back at market history, we almost always see recoveries in the market before it's obvious in any way. So we kind of are living in two different worlds right now. One is the market, which is beginning to recover from the bottoms that we saw. Specifically, I believe it was that day before Trump had announced the pause. We had reached some very, very depressed levels, and then we kind of sunk back to those levels. And now it's really just been kind of messaging from people like Scott Bessent in the administration, basically saying that they are going to de-escalate. And there's a belief that there's going to be de-escalation. Now, you have the markets ingesting that, and then you have a reality in some industries like logistics, where many people might have seen Apollo Management released, I believe it was a 40-deck slide about the economic chaos that's about to begin, and shortages and data that we see from container ships coming into ports in the US, which all looks very bleak. And also yesterday, a headline of GDP numbers turning negative. So David, there's two sides to this. One, some see-through from the market, and then there's a reality that we're going to see a lot of figures on. I tend to believe that we are through the worst of it. Things can change. But today we're going to discuss earnings, and that's a great feeling, because we've had all these episodes where I've been saying, right now, 99% of market action is largely just based upon, are we going to see a recession and macro fears? And we are starting to get very specific numbers from companies and growth rates within the AI space that we can discuss today. So, David, that feels good. I'm ready to not talk about tariffs. I'm just ready to talk about companies and AI growth again. It is a new morning in America, David.
When you said maybe the worst of it is behind us, can you just define that a little bit? When you say the worst of it, is that being the tariff confusion of kind of what is going to happen, or we've seen market bottom? I want to make sure I'm hearing you correctly on what you're saying.
No. That's a good clarification. We're going to discuss earnings a little later, but one company that released earnings that I paid attention to pretty closely in recent weeks was Vertiv, and they released a series of numbers. Here's our upside. Here's our base case scenario, assuming April 22 tariffs. And here's our bear case. And here's below our bear case, which is basically assuming the worst of tariff numbers announced on April 2nd, right? So I believe that the administration, having had meetings with companies like Walmart and Target, talking about some of the implications that could happen of consumers seeing barren shelves and economic problems, has firmly moved into more of a de-escalation mode. This doesn't mean that you're not going to see headlines from one day to the next that could be contradictory to this idea. But I believe that in terms of the market ingesting what the absolute downside scenario could be, we are now past that point, and I believe it's unlikely we will reach it again, because again, it's seeing through some of the near term kind of bad headlines around container ships and some of the economic activity as we do reach a slowdown from tariffs taking effect, and it is seeing that see through to where it believes the market will be kind of in the back half of the year. So again, you made a joke. We'll say exactly what happens next with tariffs. Things can change, but it feels like the rough trajectory has advanced from the last time we spoke.
Mm-hmm. Interesting. I don't know where I stand on it. I think when you talk about the COVID see-through of, it's a question of, are we in late March or early April of 2020 when the market was seeing through? But when you talk about when you have people kind of sounding the alarm on, hey, we could have empty shelves, or this is a bottleneck that is not going to show up for a few months, it almost brings me back to January 2020, when I remember you were someone who was sounding the alarm bells early on COVID of saying people don't understand that this is going to have a ripple effect that's coming in a month or two, because people have a hard time of understanding everything that's coming in, the exponential growth rates. Obviously, that we're dealing with a different animal in tariffs versus something that's growing at an exponential rate and can spread amongst people. But I do a little bit worry about that as well, of we're not fully grasping what's coming in 3 months. So I don't know where I stand. I'm going to lean towards you of saying it's de-escalation. We're going to get through it. Hopefully we don't have empty shelves, because I do think nobody wants that. We had that in 2020. So no one, which is obviously just very interesting. I think the fact that we had that experience is probably greatly painting what the administration might want to do, because that's just a terrible look. So I don't know. I think it's going to be very, very interesting. I hope you're right in that we de-escalate and we're not in January 2020 and then are set up for more pain in a couple of months.
Well, and I think you raise a good point. Number one, I still have my emergency food supplies I bought in January 2020 in my basement. If you'd like,
are those still good?
I won't check the best buy date on those. But second, you do need some humbleness. We have been for our careers closely following markets for getting closer to 20 years now. I hate to say, but at the same time, we try to focus more on trends and companies, and you need to be humble about the fact that macro matters. Everyone's kind of doing a heavy degree of guesswork. So I make those statements with a loose degree of conviction, but as we'll discuss today, I'm really liking what I'm seeing in a lot of these earnings reports, and it's exciting to get back and talk about actual companies.
Yeah, well, let's do that. Let's move on to the companies who are run by people whose incentives every single day are to figure out, how do we manage this company? How do we grow it? Let's start with Meta, one of the obviously biggest companies in the AI space, reported earnings. Market seems to have somewhat liked what it saw. I think that I saw the stock was up 5-6% pre-market. Obviously, still kind of down significantly, maybe 20+% from its highs that we saw in February. But walk us through, what did we hear from Meta? When I looked at it, it looked like if you didn't know anything about the tariffs or anything going on in the market, you'd be like, yeah, advertising business looks good, adoption looks good on some new tools, and they're raising capex. So it seems like Meta is going on business as usual. But is that what you took away as well?
Yeah, that is kind of the story of the markets right now, that if you didn't know everything that was happening in the background, especially with these technology companies, everything looks very solid. As you know, we're filming this Thursday, May 1st, pre-market. I believe Meta was up 6% last I looked. The headline is revenue and profits, both very encouraging from a company facing economic pressures. As I've talked about, Meta is a company that, if a recession looks very likely, or as a steep recession, advertising just tends to be an industry that gets hit one of the hardest. So that's why we've seen Meta, and to some extent Amazon as well, because they have advertising and consumer services, take it a bit higher on the chin. So revenue up 19% year over year in constant currency terms. Their guidance, even assuming some currency kind of headwinds, was above expectations. And right now, as I know, the market, it's not looking at numbers from the prior quarter so much as what companies are forecasting ahead. It's trying to say, is this as bad as we fear, or is this company going to be more resilient? And Facebook's indications are more resilient. But David, if you're viewing this show, you know which numbers we are always watching. That is the capital expenditures from these companies to talk about what the investment in AI is. And the question has been, are they going to cut? How much could they cut by? And as we've talked about, the price of stocks that are receiving revenue from AI, largely concentrated in the semiconductor industry, has not increased. Now, I should say has not increased since kind of this AI boom has begun. Now, that number is a little old, and we've seen a rally in recent weeks, so maybe there has been an increase. But this has all been during a massive growth in spending rates for data centers. So what did Meta do? They shocked the world after DeepSeek, saying they expected to spend 60 to 65 billion. The only question coming from Wall Street has been, are they going to cut? Are they going to cut? They increased it. Mm-hmm. They took the number up. I mean, if you looked at the stock charts for these companies and you knew that across this entire time you were seeing companies cutting, it would almost look illogical. But Meta, they had previously had 60 to 65 billion in spend this year. They took that number up 64 to 72 billion. That's up 9% from the prior midpoint. So here's a quote. Zuckerberg says that they're still compute constrained relative to all other AI projects, experiments that they would like to commit to. And that plus tariffs is driving CapEx higher. Their CFO said, so even with capacity that we're bringing online in 2025, we are having a hard time meeting demand that the teams have for compute resources across the company. David, there's a podcast that focuses on AI matters. It gets a little more in the weeds, but it's named the Dwarkesh podcast. It's pretty popular. And Zuckerberg was on doing kind of a PR tour. I saw another email of him doing an interview this morning. But in that interview, Zuckerberg, he went into details about what's going on at the company. And he said pretty close to what I just said, that they took all their prior ad experiments and they tried building a system where they could use AI to essentially say, create new hypotheses and kind of rank them. And they found that just with what humans at the company had determined, they were constrained. And that's before they even begin using these kind of next generation systems of AI iterating to kind of create more advertising results and also engagement time in all of their apps. Mm-hmm. So another factor I think that was really interesting with Meta, we've kind of talked about this, is many of these companies will probably use some of the choppiness in the macro environment to decrease kind of their human costs and increase their artificial intelligence costs. And that's what we saw from Meta. Well, they're taking up their capital expenditure number. They also took down their total operating costs. Well, David, if you take up your capital expenditures, that means you plan to reduce headcount, right? And I think this is exactly what we're seeing. This compute investment from these leading companies that were first to invest in AI, it's going to go towards replacing. It's exactly what Meta's trying to do. They used to have thousands of hypotheses around increasing advertising that came from their employees. Increasingly, it's going to be an investment in compute to do that function. So, I don't know if you've got anything else from this, but the headlines for Meta is just they're taking capital expenditures up, which is something I don't think was on anyone's minds heading into this report.
No, I think that I don't have much to add. I think Meta is going to continue to be, if you're buying it today, it really feels like, they have the ad business, they have the AI. It's really a bet on, is Mark Zuckerberg going to navigate whatever happens in the market? Is he going to be responsive? Historically, he has been. So I think the company really just continues to be a bet on him and his ability to navigate the environment when he's not doing Theo Von podcasts. So whatever he's doing, I'm sure it's part of his strategy.
Theo Von as well.
But he was on Theo Von, yeah. So I just think of any company, of any of the companies that we talk about, the big ones, maybe outside of NVIDIA with Jensen, it feels like he is the biggest factor in the company and kind of what he sees as the future. Obviously, he doesn't bat 1,000. He's had some misses, but I think kind of over that 5-10 year time frame, you're kind of betting on he's got almost unlimited capital, and is he going to manage it properly? So we'll see what happens. Let's move on to the next set of companies. We also had, we got earnings and commentary from Microsoft, Google, Taiwan Semi. Where do you want to jump into next?
Let's do Microsoft. They reported last night. Same with Meta. I'm still ingesting kind of what I saw, but David, the headline figure, something that people did not expect, a reacceleration of their cloud computing division, which is Azure. Headlines, their earnings last quarter, they beat expectations pretty soundly, $3.46 versus $3.22. But as I noted, everyone's looking for guidance. They want to see where things stand in the future. On that front, Microsoft's guidance was very good, $74.2 billion versus $72.3. People have been expecting companies to guide down. You've got them beating guidance. I think Microsoft's up 9% pre-market, which is an absolutely massive move for a company this size. But, we focus in on Azure. One expectation, there's been so much chatter, we'll get into it more later, about Amazon cutting cloud computing forecasts because of the deceleration that's going to happen to the cloud industry. Microsoft comes out and announces an acceleration. They grew its expectations for next quarter, I think, was 34 to 35% in constant currency. Previously, that was 31% in the prior quarter, and 16 points of that growth, grown from 13 points the previous quarter, is AI. So, Microsoft too, they're saying we are in a supply constrained environment with AI that's going to last through June. As you know, David, Microsoft has been the biggest question mark in terms of AI spending because they had committed to $80 billion this fiscal year. They have been getting out of contracts. As I've discussed on this podcast, they should stay pretty resilient in near-term spending, but they have to balance the fact that they're spending towards OpenAI. They are now handling more of OpenAI's inference, which is actually running the models, whereas the training spending has shifted towards Oracle, right? So there's a lot of choppiness in the background. It's been ingested as negative by the market, but the reality is more nuanced. And, David, in our last podcast, we were talking about servers melting at OpenAI as they released their new image tools. And, we're seeing that flow through to results in a company like Microsoft. The headline is, you could have seen, you would expect, given all the uncertainty that's happening, cloud computing to be taking a big reduction. But it accelerated at Microsoft, and that's going to continue fueling investment as long as these companies are saying they are supply constrained.
And as moving over to Google, obviously not the same business as Microsoft, but competitors in the cloud, and there's some commonality there. Are we hearing a different story from Google, or is it all kind of similar of like continued growth in the cloud? We're going to keep spending. Obviously, they don't have the OpenAI relationship, a little different, but they're obviously in the AI game. So let's move over to Google. And I'm curious to hear, is there any differences in these stories, or are they all continuing to row in the same direction of kind of telling the same underlying story?
Yeah, and Google reported before Microsoft and also Meta. I would say its earnings were a little more mixed in the sense that they're good, but with some qualifications. The qualification would be they didn't provide guidance or commentary. So again, everyone's trying to look forward, and Google was far more muted in that respect. Another respect that I think, again, this is nuanced. Google only grew their cloud computing division at 28% now. I should use only in air quotes. That's extremely good growth. But when I'm talking about Azure accelerating and Google decelerating, it implies that they are losing some market share. Google's explanation is that they called it a high correlation of cloud computing growth rates with their ability to get many of these new AI data centers online. So their explanation is basically, we are investing heavily. We haven't gotten those new data centers online. Once we do, our growth will reaccelerate again. So if you are an artificial intelligence bull, that would be positive read through on that. The other thing about Google was they had a good prior quarter. Their profits hit 30.6 billion versus estimates of 28.7 billion. And they also reiterated their spend this year on capital expenditures of 75 billion. So, for those keeping track at home, we have had Microsoft at 80 billion. They are shedding leases, but they also very aggressively were taking leases last year. And they are saying that they are continuing to be in a supply constrained environment and that they will grow their CapEx once again the next fiscal year. We have Meta taking capital expenditures up very unexpectedly, I would say. We have Google reiterating the number that was a surprise months ago. And the one company we haven't gone to is Amazon, which has yet to report earnings, but we can also discuss them in a little bit. I do want to finish kind of earnings as you mentioned.
Yeah, let's wrap up with Taiwan Semi. Again, a company that had been struggling like many of the other companies in space, despite what we've talked about on this show of the outlook looks pretty good for this company in terms of revenue growth, profit growth, but the market was just not buying it, and it had been selling off. So what did we hear from Taiwan Semi? Did it again reiterate that case, or are we starting to see some sort of challenges there? Has the market been correct?
Yeah, I'll finish with earnings. I'll mention two companies, Taiwan Semiconductor and Vertiv, because I think those were two important reports. First of all, Taiwan Semiconductor, they reiterate they still expect AI revenue to double this year. They still expect overall top line growth to be in the mid-20s. Now, one thing that's interesting, there's almost no company in the world that is as impacted by geopolitical headwinds as Taiwan Semiconductor, because as the concept of a trade war begins, it's not just tariffs, it's also increasing the possibility that there could be an actual confrontation with China, which, this company will always have a discount because in that scenario, it could be worth somewhere between zero and dramatically less. Now, I will note, Taiwan Semiconductor, they continue to increase their investment in the United States. They are now up to plans of 165 billion between R&D and fabs. They're breaking ground on a third fabrication facility. And like in the past couple of weeks, you also had NVIDIA announced that they want to move their supercomputer supply chain to America. Now, there's part of that's PR, but there is a reality that they want to start using the fabs from Taiwan Semiconductor that they're building in Arizona today. So you have some level of maybe decoupling this risk. I don't know how much that's going to reduce the overall discount Taiwan Semiconductor gets, But another factor, there's been reports that they're increasing kind of the rates that they can charge in the US fab facilities by up to 30% because companies so badly want to move production to areas not impacted by a trade war. So in a weird way, Taiwan Semiconductor's getting some tailwinds from this that people might not have expected.
They're almost able to kind of pass through the increased cost of production here to the customer.
Currently, yeah. And the other company I wanted to mention was Vertiv. They hiked their revenue guidance for the year to $9.57 billion at the top end. That was incredible surprise to the markets. I think they were up the next morning, like 17% pre-market. The same day, we saw other companies, GE, Vernova, Amphenol, just companies in the supply chain that we've talked about, both released incredibly optimistic earnings. And the other thing is, we broke down why probably the headlines have done a disservice to people about how much tariffs could impact a lot of the kind of component chain that's going into these new AI data centers. And I specifically called out that Vertiv is a company that has a lot less exposure than people thought. They did a great job on their earnings. They broke down, they gave guidance, they broke down according to where they would fall with different levels of tariffs. They gave exact numbers on their exposure. They claim single digit exposure to Chinese supply chains. And they also, with this guidance that they gave, assumed tariffs at April 22nd rates. So if tariffs come down from these levels, there continues to be upside. So David, it is just when you're looking at companies that are at the beginning of the supply chain, the companies giving the power generators, the companies doing a lot of the cabling that go into this, the companies doing cooling and essential supplies, it has been almost universally very positive this earnings season. So while there's a lot of fear out there, the companies at the beginning, before you get to the NVIDIA chips, before you get to the networking, before you get to all these other things, are saying basically green light, growth is above market expectations, barring something really bad geopolitically happening. It really looks like a substantial kind of growth wave happening as we kind of get through this year.
Yeah, not to pour cold water on it, but it kind of comes back to your point of a company like Vertiv. If you're saying not super exposed to tariffs, it comes down to recession, yes or no. Yeah. And is there a big 100%. Pullback in overall CapEx? And that seems to be one that if we power through and there's no recession and things work out, things de-escalate and companies are back on and consumer confidence is good, it feels like a Vertiv's one where I'm not making a call here. It's like that's a stock that could go up, that could double in a 12, 18 month period. If it's no recession, growth back on, that's a company that, is well positioned. But again, that's where it comes down to. I think I saw maybe it's on Kalshi or something. It was like recession odds up to 75%, which that's a betting market. I think in 2022, it read as like 99% chance of recession, and that didn't come to pass really. So we'll see.
And it's worth kind of double clicking on that because you can have recession odds at 75% and it be an overall good market for companies. Because if we had GDP negative this last quarter that we've already moved past and companies are reporting good numbers in the technology space, and we have negative this quarter, which is you need 2 quarters to qualify as a recession, and we see the forecast being very good this next quarter. If that's the bottom environment and these companies move through it, you can have a recession that's a good outcome. What you can't have is a recession that really takes down overall economic activity and remains sluggish. So there can be a scenario where we have a recession and we power through, right?
Yes, of course. All right. Any other earnings? I think that was all the companies that we had wanted to talk about.
No, I think tonight we'll discuss on the next podcast, but Apple is going to report, Amazon's going to report. We'll be looking at those. But, there is other news outside earnings with these companies as well.
Cool. Any other news stories that you want to hit on?
Yeah, I would. Number one, just to show how dynamic this environment is. The last time we filmed the podcast, I had said, wow, there's a report out that NVIDIA might have talked the Trump administration into relaxing export controls on its chips destined for China.
Mhm.
There was a report. It was from credible sources, and it was completely wrong. Days after that, NVIDIA filed a 10Q, taking a $5.5 billion inventory charge. So it again, that as much as there is general optimism, we are fast approaching a situation where we have something like a new Cold War, where kind of instead of a space race, it's dominance for AI. And you will have some headwinds that a lot of these companies are going to start losing exposure to China, having competition from China. But we also might see it as somewhat of a national priority, as kind of a countervailing measure. So that's something to track in the near term. That's going to probably hit some semiconductor equipment plays and a company like NVIDIA the most. But yeah, it's something to track, and we're going to have new kind of what you'd call export diffusion rules coming out soon, and we'll see. I wouldn't expect that to be overly positive to NVIDIA. The other thing was we had another kind of what should we call it, a market freakout in recent weeks about Amazon cutting their capital expenditures because they had kind of they basically left some leases in Europe. As we saw with Microsoft, there was a mad rush in 2023, 2024 when all of when all of these AI developments were first springing up. Every single company was trying to secure as much capacity as they could. And now some of these companies are walking away from that, as Microsoft has. Now, even walking away from some of these, their spending is significantly above where consensus had been. Amazon, after this report came out, I believe it came from Cowen, which was the company that has been kind of spinning up the Microsoft stuff as well. I wouldn't say they've been giving a great overall perspective on that situation. Amazon came out and said, hey, this is normal course of actions. We are walking away from some leases because we are kind of recalibrating our strategy, but we still expect to spend $100 billion. They report tonight. I would expect them to stick to their goals. Again, as we've seen significant fear around other companies, the overall figures and commentary has remained extremely positive. So if you were seeing a lot of the stocks selling off after this kind of Amazon rumor or report or whatever you'd like to call it was issued, I think it's largely a non-story.
All right, cool. So it sounds like we'll get more context later tonight, more stories coming down the line. To me, it feels like there's a common thread of, it feels like there's every few weeks, there's these big AI stories that grab the headline for a few days, and then you wait a month and it kind of fizzles out a little bit as a main story. So I think that's just going to be a common feature of this, growing emerging technology where, oh, is this a big thing? And then it's kind of like, you almost got to check back in 2 weeks, see if it's still, see if there's more context, see if it's still relevant. Because reacting to every single, potential news story can get certainly exhausting and probably not a good use of time. I wanted to wrap up just touching on a little bit of personal experiences using AI, how the tools are advancing. I saw a tweet from our old colleague, Morgan Housel, who worked with us at the Motley Fool for years, who's now a very well-known investment writer. He tweeted the other day, ChatGPT, and kind of gave a timeline. 2022, cool toy, fun to play with. 2023, don't use it much. 2024, use it a few times a week. 2025, use it every hour. Anyone else like this? So I think that was an interesting way to capture his journey using some AI tools. I was curious to get your take on, do you think that's an experience that many other people are having? And how are you kind of interacting with the technology these days?
Yeah, I think that tweet captures it well. And David, I'll be curious for, your perspective on this as well. But I have seen such an exponential level of growth in AI in our, it's a small company, our little hamlet of the world, if you will. But the levels of problem solving from using AI has just been increasing at such a phenomenal pace. It is kind of bewildering to me to watch. And this is knowing before we probably have a very high level of capability increase with the advent of agents that, we believe will be a storyline as we head into the back half of the year and throughout 2026. So, my recommendation to everyone out there, I was talking with someone the other day, and, they would use ChatGPT for some queries and, ingesting it, much like Morgan was talking about in that 2024 timeframe. And I had told them, you need to start using it for problem solving in a much more thorough way. And I had said, why don't you just, here's a project. And I suggested something around using it to create, just basically vibe coding, as you'd call it. And they came back to me 2 days later and they said, I cannot believe how good this is. And I am working on 3 projects that I previously would have had no way of knowing how to address it. In our business, whenever there's a new problem, we now think about how to use AI to address it first. And the capabilities and what we believe we are able to achieve that's going to create meaningfully better products for customers has astounded me. So I think right now, if you went a time machine, you went back to 1996 and you were telling someone what to focus their time on, it would be obvious today. You should think about every single kind of business concept that's not on the internet and how to apply it there, because we will get there. We will get there in a faster time than people expected at that point. And the leverage you have put into every single hour working on that problem of how you take previous business ideas that didn't incorporate the internet and the growth of technology, the leverage on every hour you spent would have been phenomenal. So I think for everyone out there, 2 points from this. Number one, my personal conviction and what I'm seeing from AI, how I'm seeing people around me use it for problem solving in entirely new and novel ways, has been increasing at an exponential rate. Second, this is a podcast about investing and what stocks to buy, but a personal kind of plea to everyone that if you are not incorporating this into your own life, the time is now to start, because if you can start using AI for entire new ways of problem solving, incorporating in your workflows, you're going to be extremely powerful. You're going to be more employable than ever. And the leverage per hour spent and how capable you are is so extreme right now. I think if it's been something that's kind of a toy to you, we are beyond the toy phase. It's time to really begin making this a part of your daily routine, because you're only going to be able to thank yourself in the years to come. It's not a matter of this will probably be the case. I'm certain this is the case at this point. So, David, how are you thinking about?
No, I think obviously the comparison to going back to 1996 and asking someone how they should spend their time. I'm sure many people have seen, if not, Google it, the clip from 1994 morning show. I can't remember the host when someone brought up internet. Again, 1994. So, think about the time frame a little bit. And it was like, what is internet? I don't even know what internet is. And, you could fast forward even just, by 97, 98, the internet was a massive technology. Now it looks much different today than it did in 97, 98, but things are moving faster. What's 1994 today? That, is probably the 2022. Just call it when ChatGPT launched. And that was probably like, what is AI? And now we are 3 years later from that. So you can think about internet 97 to the internet became, everything within just 5-10 years from that date. So obviously agree with you that there's no going back. And I'm sure many of our listeners have careers that they don't really see. I don't know why I would use that. If you're a dentist, you might be like, I have no use for some of these AI tools. And I totally get that. But yeah, maybe trying to integrate it into your own life, just starting to get comfortable with it. I would also give that same guidance, because it seems like a tidal wave coming. And if you're not prepared, it might not be, you could be feeling left behind for sure. So I'm right there with you.
I think the clip you were referencing, I think it was 1994, and it was the co-founder of the Motley Fool, David Gardner, and they were thrown to a segment for him, and they're like, meet the weirdo who thinks you're going to use a credit card over the internet. And it was
another one. Yep.
So astounding. And of course, that's an obvious outcome of what the internet was going to be if you knew what the internet was. And it just took a few years But at that point, if you had a business idea of applying to e-commerce, it was consensus that 99.9% of people thought it was crazy, and it was obvious that 99% of people were going to be wrong. And there's a lot of things like that at this moment today. So if you are on the other side of that, like I said, it's going to be very powerful for your life.
And of course, the interesting and hard part of investing is that right now where we sit, it feels inevitable that AI is going to create immense value. There's a different question of where that value is going to be captured and which are the companies that are going to be doing it. Again, if you went back to 1994, 95 and talked about which companies do you think are going to be driving the internet, a lot of them probably created a lot of value, but did not capture it for their shareholders. So that's an entirely different question. It's what we're trying to bring on this show, trying to find the companies that are positioned to actually generate and capture some of that value, because those two things are often very different in the world of investing.
Yeah. And I think that kind of comes down to there's two aspects of your life. There's your investment capital and there's your personal capital, and how well you're able to go out and make money. So the investment capital, as we've talked about, the most obvious AI plays up to this moment actually as a category have not made money since this kind of chat GPT moment began. There's examples like a Palantir and NVIDIA that have, but across the board, it's been a difficult operating environment. The operating environment's been great. It's been a difficult stock environment for this group of stocks. But again, well, investments may move in one direction, people can control kind of that personal side and should be thinking about that today. So yeah, I just wanted to make a little, I don't know if you'd call it a plea, but like I said, my conviction is radically increasing. And I hope everyone out there is not just thinking about the investing side, but thinking about how they are bettering their personal life advances we're seeing.
All right. Well said. That's everything for today. We'll see everyone next episode. People on this show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.